All right, welcome everyone to today's federal budget update on SMSFs. And this is something that for the past couple of years, it's been relatively quiet. So I always assess by the time that I go to bed after budget night as a guide as to how much was really in it. In the last few years after that 2016-17 budget, where I think I was up till probably 3:30 or 4 o'clock in the morning with those changes. And then we had a few years where I was able to catch up on that sleep. And then the other night, I think it was till about midnight or 12:30. So there were a few things in this budget that are going to have an impact on the SMSF sector moving forward. And today is making you aware of what those items are, but most importantly, start to give you a little bit of insight into some of the thinking that we can look forward to with these strategies as well. Of course, on the understanding that these measures ultimately do become law. And the most important thing to remember here as we talk through each of these topics is that the devil is always in the details. So until we get exposure drafts around these things, we are somewhat theorizing, but making calculated understandings here, of course, based upon the law that already exists in respect to most of these measures. So without further ado, let's start kicking things off in terms of the topics that we're going to be looking at. And of course, everything that we do is based upon our information as we understand at the time. You all know how these disclaimers work, so I won't cover that any further. So what we've seen are a number of areas that impacted the SMSF sector from the government's announcements in the federal budget on Tuesday night. So we're going to explore each of these. So we're going to look at the First Home Savers Super Scheme and the extension that's been provided in the release of benefits. And this in particular is an area for first home savers that enable them to, in essence, use the tax sheltered environment of superannuation to build up enough that they can then use for deposit and then get that release of payment out of their superannuation fund under these specific regulations. We'll then explore the downsizer contributions. We've seen some news there. It was actually announced prior to budget night, so we had some idea that this was coming along. The reduction from age 65 to age 60 in respect to an individual or husband and wife, where they would be able to make those downsizer contributions into superannuation from the sale of their principal residence. The repeal of the work test is another area that we have seen for some time, this government trying to introduce introduced by way of repealing that work test requirement. So this is their second crack at it, because they did try and introduce this measure back in the 2017 reform measures. So from the 1st of July 2017, but it was ultimately knocked back. So therefore they pulled that information out. They have had another go at this with this budget, but focusing predominantly on voluntary contributions here, rather than the deductible member contributions. And we'll talk a little bit about that separation in here. We've seen the removal of the $450 superannuation guarantee threshold, obviously opening up access for contributions for a much wider number of individuals, some 300,000 according to the budget papers. And the other two here, very specific to SMSFs, that we have seen as an industry, a lot of submissions being made to government over time, trying to address these issues. So the first one around legacy pensions. So this 2-year window to unwind these arrangements that fell under previous legislation. So specifically looking at market-linked pensions, and then also the old defined benefit pensions. So we'll explore some of that, and they have a little bit more information that is covered within their fact sheets as well. And the other one was relaxing the residency rules for SMSF. So we had our 3 limbs in respect to the way in which an Australian superannuation fund is defined. We are going to see the removal of one of those limbs, the active member test, and an adjustment around the central management and control. And we will finish off with the area of what we didn't see, because sometimes it's what we expected to see that we didn't see that may have some impacts here on us. So we'll finish off with that as well. So let's get stuck into it. So the one here, first and foremost, is our First Home Saver Super Scheme. And as I said, the government has announced here that it will increase the maximum releasable amount, currently at $30,000, now increasing to $50,000. So where an individual makes either voluntary concessional contributions into super or voluntary non-concessional contributions into super, those amounts will qualify for the amounts to be released, obviously within the threshold that applies here. Now, what we do see is when we make those voluntary contributions, there is also a limitation on a yearly basis. So we can't simply make a one-off amount and then look to release that. There is an existing limit of $15,000 per year that will then apply towards the release amount that ultimately is taken by that member. So this is looking to be introduced on the year, in essence, following this taking effect. So in essence, and this will apply to the large majority of the measures that we saw announced the other night, that we see a likely start date here from the 1st of July 2022. So we also saw, in respect to the first home saver scheme, a number of other technical amendments that are going to be made simultaneous to the release amount being increased. So the couple of things here to note is that there is going to be an increase in the level of discretion for the Commissioner to amend and revoke applications, of course, where an individual does not necessarily meet those qualifying conditions. It will allow for an individual to withdraw or amend their application prior to receiving that first home saver release amount, and also allow for those who withdraw to withdraw that application, I should say, to reapply for a future release as well. It will also provide the Commissioner to return any released amounts into super, provided that that money hasn't yet been released to that individual. And then finally, that when that money is returned, it is treated as non-assessable, non-exempt income and does not count towards the individual's contribution caps for that year. So again, just some technical deficiencies in the way in which the law is currently drafted. That legislation, if that goes through, as indicated, will have a retrospective date of the 1st of July 2018. So a word to note there. Now, for me, I'm not sure where you see this with a lot of your clients. I haven't seen a huge amount of activity, in particular when we think about SMSF clients. I'd love for you, just even in the chat area, have you actually had a client utilize this within your SMSF client base, or maybe even generally? Because I don't actually see this as playing any real significant role in this strategy being utilized more heavily, and in particular with SMSF. So the threshold itself, to me, isn't necessarily going to be a catalyst for more people to be able to use this. So what we've got there, so Daisy said, yep, I have. And my rationale, I guess, is what we're seeing is a greater reliance upon what is known as the bank of mum and dad. Now, interestingly, there was a statistic released through the Financial Review only in the past few weeks that the bank of mum and dad is now a top 10 mortgage lender in Australia. So therefore, the way I envisaged how people are really starting to get access to deposits and so forth, more is coming out of tax-free income streams. So clients may be inside pension phase or retirement phase within their superannuation fund and releasing benefits to them that way, rather than simply using a mechanism of concessionally taxed arrangements into superannuation for the purposes of then doing that release as well. So yeah, a lot of other people saying, no, not really, none at all. We haven't seen any. So from that point of view, again, I don't think it is that heavily utilized, and therefore I don't see it playing a big role. There is one area, though, that this does provide an opportunity, is that you could be using this with sort of family groups. So where there is trust distributions from a family trust and there's discretion, you may then be looking to distribute to particular children, and they are of an age where they would be building, obviously, wealth for their first home. So what could be done is, rather than that money maybe being held in a personal environment, there could be the opportunity to, of course, distribute it to that specific individual, pay it to them, and then that amount would be offset by a deductible contribution into super. So there's a negligible impact on that individual, subject, of course, to that that child's individual tax rates, whether they need that deduction or don't need that. But what it's doing is via the trust distribution, we would then be able to build up that quantifiable amount so that it could be released at a future point in time up to that maximum release amount of $50,000. So there definitely is an opportunity there to be utilizing it. I just haven't seen it personally myself in any level of significance, in particular when we think about the SMSF sector. Now, interestingly here, as I've worked through these, we have started to think about what impacts are they going to have on documentation and the way in which we govern our SMSFs. So in this respect, I don't see any trust deed changes here required with the proposed measure. Ordinarily, you may see if it's prescriptive in the deed. So check whether some of these issues, and I'll talk about it throughout today's session, if the deed is more prescriptive, then there is going to be scope to need to update particular things. But one of the things that we do within the Smarter SMSF deed is we use this concept of an authorised contribution. And that authorised contribution obviously is defined that talks about all these different various areas and the fact that it complies with the law. So if it is an authorised contribution, then obviously that amount can be accepted by the fund and won't be impacted by changes that we see around the different contribution rules. So the release of benefits here, again, same sort of scenario. If they're taking the money, the issue is the condition of release here rather than the particular threshold. So the prescriptive arrangement here, the prescriptive way in which arrangements are set up and the way the deed might be constructed is really going to determine whether there'd be an amendment or not required here. So let's now move on. And this next one here, again, was something that I mentioned before, was announced in the lead up to the budget, where the government is now going to reduce the eligibility age for a downsizer contribution to be made. So currently, the law provides for that individual needing to be 65 years of age at the time the contribution is made. Now, there are, of course, a number of eligibility requirements to be able to make that contribution. So we have our 10-year rule, we have the principal residence exemption in part or in full that applies to it, and we have 90 days in which to make that contribution after settlement as some of the, I guess, the main eligibility requirements there. So the first thing to note there is that the individual needs to be 65 at the time the contribution is made. So we could have circumstances again here, subject to that finalisation of legislation, where that individual may be 59 years of age at the time the asset is sold, and even when the proceeds are received on settlement, but by virtue of them turning 60 within that 90-day time frame, it would make them eligible to be able to make that contribution, because that's the way the rules currently apply for someone 64 that turns 65 during that period of time. So again, we need to wait to see that further, but that concept, you would argue, would carry on here as well in respect to the 90-day time frame. So this allows for individuals to, of course, contribute up to $300,000 per person from the proceeds of selling their family home. And once again, the likelihood of this legislation taking effect is expected from the 1st of July 2022. So let's have a bit of a think about as we work through this issue. There are a number of big opportunities. Now, interestingly, statistically wise, in the very first year that this legislation was introduced in the 18-19 financial year, we saw over $1 billion of contributions into superannuation as a direct result of this legislation. So it's certainly something that is opportunistic for clients to explore, and is even more so now and opens up a broader catchment of what we call our empty nesters, and to not only be thinking about making contributions into super using the downsizer, but we're going to start to see this simultaneous ability to make contributions as well, combining with NCCs. So here we've got the opportunity to make a $300,000 downsizer, potentially $330,000 NCC from the 1st of July as well. So $630,000 per individual times 2, we're up to $1.26 million. So significant amounts of money that we can look to get into superannuation. Or in most instances, what we do know is that individuals sometimes won't necessarily be down, they might be downsizing, but they're not downgrading the type of asset that they might be holding. So therefore, this strategy provides still the opportunity to use a recycling strategy or recontribution strategy here. And you can see I'll talk about that on the right-hand side, whereby we can start to replace taxable component monies with tax-free monies through potentially the combination of both NCCs and downsizer contributions. Now, the issue, of course, that now gets introduced with this legislation is that when someone was 65 making the downsizer as it currently applies, there is no preservation considerations because attaining age 65 is a condition of release with nil cashing restrictions. Whereas now, once a contribution can be made where that individual is 60 years of age, we need to consider that position of a condition of release being met for that money to become accessible. So if we have a person that has retired, we don't necessarily have any problems there to be able to undertake the access to be able to potentially look at that recontribution strategy, as I was just talking about before. But it doesn't mean that just because it's preserved that we can't look to undertake that sort of strategy, because we could still look to use transition to retirement income streams. Even though we might not be getting the tax exemption in the fund, there is the ability to draw down a 10% maximum, for example, subject to the quantums that are in the fund, to still look at refreshing the components of that superannuation income stream. So there are a couple of things here just to note. So the first one you can see on the bottom is that the downsizer rules as they currently apply aren't just in respect to having to use proceeds from the disposal of that asset. So Law Companion Ruling 2018/9 does tend to infer that that is the case. Now, the SMSF Association over the past couple of months, or probably 6 to 8 weeks, did go back and make an inquiry here to the ATO, because that is not how the legislation is drafted. And what the ATO did confirm here, and this is looking at it in respect to the in specie transfer of assets into the fund, that you could actually look at utilising other assets as long as the contribution that is being made is a direct result of the disposal of that principal residence, and therefore those contributions being tagged as a downsizer contribution. So there is an expectation that that LCR 2018/9 will be updated to reflect what should be the case here and the way that the law is applied. So again, that might be an opportunity with some of your clients as they look to maybe, again, sell down particular assets. They may be limited by how much they can get into a fund as an NCC. They dispose of an asset of their principal residence, and they may own shares and so forth in their own name. And therefore, you could be looking at transferring those assets into superannuation instead of utilising the proceeds from the disposal of the principal residence, when that may be used in the purchase of their next family home. So the other thing here, again, just remember around timing issues if clients are making both non-concessional and also downsizer contributions. Importantly, NCCs will count against a member's total superannuation balance. So therefore, we do need to understand the limitations by that threshold to determine if we have 1 year, 2 year, or 3 year bring forward, or we're in fact ineligible to make contributions. However, when we make a downsizer contribution, the downsizer contribution is not subject to those TSB thresholds. So again, it's important if we're making both of those things, and they may even have to straddle financial years subject to timing of cash flow and the like, we want to be able to get in the NCC amounts first, because they will impact or be impacted by the total superannuation balance whereas our downsizer contributions actually won't. So let's keep moving on. So again, the other thing here to note is that unless, again, it's prescriptive by way of age in the deed, we shouldn't expect to have to see any further amendments here. So again, I used that concept earlier on about the fact that we classified in the Smarter SMSF deed as an authorised contribution, and as long as it meets that authorised contribution definition there, which in this instance it would, so the age is not impacted, it's basically play on. So let's keep moving on here. And we now also see the government looking at repealing this work test, but only to the extent that it will relate to voluntary contributions. So again, this is something that the government did try and introduce as part of the 1 July 2017 super reforms. It was far more open in terms of its intent. So basically removing the work test in its entirety. So it didn't matter in respect to the context of concessional or non-concessional, deductible or voluntary contributions. In this instance, their approach is to now look at still requiring the work test to be met where that member is intending on making a deductible contribution. So here we're seeing the removal from 67 to 74 years of age. If that individual wants to make a non-concessional contribution, it will also apply to the relevance for the bring forward rule. So that takes that bring forward rule all the way through. As we know, our bring forward rule currently still only relates to individuals up to age 65. So we do not have legislation finalised at this point for 65 and 66-year-olds. This would obviously look to remedy that. However, once again, we are expecting these rules not to take effect until the 1st of July 2022. So not only will it apply to non-concessional contributions, it will also apply to salary sacrifice super contributions without needing to meet the work test. So it is only in respect to items where an individual will need to claim the deduction under a section 290(170) notice. So that is an important thing to note there. So again, as I've mentioned, this was something that they tried unsuccessfully previously, and we have this focus on voluntary contributions. The likelihood out of this is that we now would expect to see this go through without any major problems. So again, let's think about some of these issues that need to be considered as part of the changes. So importantly, it's still going to require that work test for someone to be able to claim the deductible contribution. It does further open up, and as we spoke about with our downsizers, the opportunities for us to be working closer with our SMSF clients to look at contribution and recontribution strategies around the optimization of our taxable and tax-free components. Again, going to be subject to our total superannuation balance thresholds, but we have spent a lot of time previously from 60 through to 65 and now up to 67 about recontribution strategies and employing that approach to try and improve on the tax efficiency from an estate planning point of view. So this really does open up a much greater period of time to make sure that those outcomes are right. So making sure then when we are acting in the best financial interests of our clients, when we think about the Your Future, Your Super packages, that we are actually doing the right thing. The members are looking out for not only themselves, but also the beneficiaries in respect to making sure that we are optimizing those components where we possibly can. The other thing here is that it does somewhat strip away one of our total superannuation balance thresholds, because for work test exemptions, we don't have to worry about it now where we have voluntary contributions that are being made, such as our non-concessional amounts. We are, however, stuck with it being relevant where that individual is claiming a deductible contribution. So it does make it somewhat relevant still. We're not going to see it tested, I don't think, as much on a member deductible basis as we would with NCCs. But I was hoping that we would have ultimately seen that strip away, and we were hopefully also going to get some level of uniformity, I guess, around some of these TSB thresholds. Not quite, so we still do have these that we need to deal with, but it does somewhat strip away this relevance of the $300,000 threshold, in particular with the non-concessionals, as we would no longer need to rely upon that prior year and the TSB being less than $300,000 where that individual is under 74 years of age. So again, here, once again, so unless the contribution rules were prescriptive by way of age in the deed, we are again going to be unlikely to need further amendments being made. What we are going to have to see, of course, is some amendments being made around existing documents for work test and work test exemption, which are quite heavily used on our Smarter SMSF platform and also through the BGL Simple Fund document platform that we have as well. So let's keep moving on. The other thing here we saw was the removal of the $450 threshold for super guarantee. So this is an important one, as I mentioned, because it will impact around 300,000 individuals. And this was something that was seen in the Retirement Income Review final report that was released late last year. And interestingly, and statistically wise, it will impact about 63% of those in the 300,000 women. Again, we have a 1 July 22 expected start date here. So this is obviously good policy from the perspective of helping lower income earners, in particular women that may be working lesser hours due to family commitments. The other thing to note here is that the change will also have an impact on certain arrangements that we see directors' fees being paid up to $5,400 per annum. So where that director's fee is paid, of course, divided by 12 is $450. So there is no obligation to have to pay SG on that amount. So this clearly changes the landscape now in respect to that sort of arrangement, because there will be a compulsory obligation to pay what will be 10% from an SG point of view, because whilst it was debated heavily over the last sort of 4 and 5 months post the Retirement Income Review report coming out, the government is now committed to increasing that SG amount, which we will see that amount increase from 9.5 to 10 from the 1st of July 2021. So the other thing just to note here is, who is going to carry the burden of that increase? Now, that is ultimately going to be subject to the way in which an employment agreement is ultimately drafted. So if it talks about remuneration and the remuneration is a set figure that is inclusive of those two amounts, then the employer may be looking at simply reducing take-home pay to accommodate the extra 0.5% threshold there. So again, just be aware of that particular issue. So one here we've got, so Phyllis, is removing the 450 threshold applicable to a minor who is working less than 30 hours a week? Yes, it would be. On face value, yes, it captures everyone who would ordinarily otherwise have been excluded in respect to those contributions. So let's now move on to a couple of very specific SMSF measures. So the first one here, and both of these, I should say, have formed part of submissions to budget submissions to government for some period of time. So the first one here is around what we know as legacy pensions within SMSF. So we're taking this back to defined benefit income streams, lifetime complying, lifetime fixed term, life expectancy, defined benefit income streams, and also market linked pensions. All of these no longer are allowed to be commenced unless they are related to a pre-existing complying income stream. And again, the concept of complying here, and I'm showing my age, is that these were tested previously against the pension reasonable benefit limit as opposed to the lump sum reasonable benefit limit. And I'm sure there are a couple of you on here who go, yes, I'm probably that old too, where I do remember some of that. So what we're trying to do here is free up our industry of these legacy pensions that have a larger number of complexities attached to them because of solvency issues and asset test issues that are all now grandfathered in many respects. So what the government has indicated here is that they're going to allow individuals to exit these legacy retirement products along with reserves here that are associated with those for a 2-year period. So there'll be an amnesty that we'll be able to work through once this is legislated. And again, it will apply to market linked pensions, lifetime and life expectancy, not flexi pensions. Those flexi pensions were actually lump sum RBL tested as opposed to pension RBL tested. So there was a mechanism to unwind from those in any event out to an account-based pension. So again, this is to apply from the first financial year after royal assent of that enabling legislation. So unless we see this go through prior to 30 June this year, again, the likelihood is it would follow in 1 July 2022. So let's have a look at this. So again, finally, we have an opportunity to unpack some of these. There's not a huge number of these around proportionate to the industry at large, but it is going to allow these individuals to move to a more simplified arrangement, i.e. an account-based pension from the fund, or even potentially requiring some of that to remain inside accumulation. So the real balancing act here, though, is going to be the trade-off in simplicity of the account-based pension functionality versus the asset test or partial exemption that may already apply in respect to that income stream. We will have income streams still that have 100% asset test exemption. We will also have some of those in particular with market linked pensions where there was 50% asset test exemption. So there is going to need to be some pretty strong analysis around that to weigh up this concept of, well, is it better that we do it this way? And we therefore unpack these arrangements that actually give the client more access to the capital, because again, in a defined benefit sense, we may just be having we would have a predefined amount, maybe indexing the CPI or a 2 or 3%, whatever the calculation was that was initially set out. With our market linked pensions, we have our prescribed amount with a plus or minus 10% variance. So the account-based pension is going to give us much more flexibility around that, but it may also then have an impact on the level of age pension that is supplementing their income needs there. So again, I would expect to see a fair bit of work needed to be done around these, in particular with our asset test exempt clients. So again, our current considerations here are that we can only convert those compliant products into another compliant product. So we did see a number of those defined benefit pensions that were used previously for RBL purposes get unpacked and moved to market linked pensions. So this is the next rollout that can occur for some of those. May be beneficial, again, maybe not. The other thing here just to note is that we not only have to consider our asset test trade-off, our age pension requirements, but we also need to consider the concessional contribution rules around our reserve allocations. So again, we need to look at our regulations. I think it's 292/2501 that talks about that allocation requirement and whether that amount is fair and reasonable within the 5%, and therefore whether it may get included as an assessable contribution for contribution cap purposes. Now, interestingly, that allocation rule doesn't matter for contribution cap purposes around whether that individual's 87 or 95 or 78. We still have that opportunity for the allocation to be applied against them on a $25,000 basis. So if we have an asset test exempt income stream, individual that might only have $250,000 left in that complying income stream, they could also not only get with the reserve allocation, not only get the benefit of that 25 allocation for the year, but they could also then use the catch-up concessional contributions, which at that point, by the time this legislation comes into effect, might be 4, even 5 years potentially, given the 2-year window of unused amounts, so that they don't get taxed on some of that reserve transfer. So again, we're going to need to wait and see a little bit more about the details here with this conversion process, but there are mechanisms and levers we can pull to allow for us to potentially unpack these with having any major significant implications for some of these clients too. So this is more than likely going to require some sort of deed amendment, because as would currently be the play with these defined benefit income streams, there are going to be different commutation restrictions that are relevant to paying these types of benefits. So again, just be conscious of the need to maybe have to look at the deed to enable this to occur. Now, we have done for some time now documents around conversions from defined benefits into market-linked pensions and so forth. So we will be building out quite clearly these legacy pension conversion documents once this legislation has been finalised. So if you do have clients in this area and you do need some assistance, this is certainly something that we have expertise in and can obviously assist as and when would be required. So let's just go through a couple of examples here that the government put on their budget website within the fact sheet. So we've got Jill, 80, lifetime compliant pension inside her SMSF, commenced back in 2003, has annual set payments that have been paid to her, and a reserve, which there are two types of reserves here. We're looking at a solvency reserve mortality reserve, which is obviously the actuaries dictating how long Jill's expected to live for, and an investment reserve based upon the expected performance of that fund over that period of time as well. And the actuary needs to sign off with a level of probability around that each and every year. Now, as a result of this announcement, Jill thinks that the product would no longer suit her, and she wants to be able to access her capital from that superannuation benefit as and when is required. So what this law is going to allow us to do is to commute the pension, including any of those surpluses, those reserves, back into accumulation, and then it would allow her to commence an account-based pension with the proceeds of that defined benefit income stream. Now, the reserves transferred back are going to be included in as an assessable income, where she may be liable for the 15% tax. So that is taken out of the example, not necessarily going to be the case. It's going to be subject to a number of factors. It's quite simplistic in terms of what they've tried to put in play there, but we'll just assume based upon the facts. So Jill has space in a transfer balance cap to commence her new account-based pension, and as the new amount counts towards the age pension assets test, we will need to see a reassessment of Jill's age pension payment rate to determine how much she'll receive in the future. But importantly, what this has done is, rather than her having a set predetermined level that is actuarially signed off each year, we now have a more simplified income stream that she can take, reduces or eliminates her actuarial requirement around that pension, and gives her, again, a much simpler way to move forward. And it may even be that she no longer needs to actually have the SMSF because of the construct of that defined benefit pension, and she can now move into a far more simplified product and investment structure. So again, it may mean that it's the end of the SMSF as well here, where we think about acting in the best interest of the client. And the other example here is with Mark. So he has a market-linked pension that first commenced back in 2005. So again, we need to look at the nuances there between asset test exemption, whether it was pre-September 07 and post-September 07. We saw some changes about that point in time. So again, he uses this opportunity to roll back to accumulation before commencing an account-based pension with some of those proceeds. Now, the reason why he can't move all of that money back into account-based pension is because he has limitations already within his transfer balance cap. So therefore, this will enable Mark to retain the rest of the proceeds inside accumulation. So there is some flexibility here to unwind, but it's not going to require that individual to have to move that money back into a retirement income stream. It may mean they have the opportunity to retain monies within superannuation in accumulation accounts, or they may be limited in the amount that they can get credited back in because of the transfer balance cap consideration. Of course, we then have to weigh up, though, the tax rate that would apply where that money is in accumulation phase. However, in this instance, Mark decides the exit's worthwhile to gain, again, greater flexibility rather than a pre-defined level of market-linked pension that he would need to take year on year. So here in this instance, again, looking at it on an assessment basis, he will continue to receive a Part H pension payment. So he's happy with that. And again, it's play on. So they're the couple of interesting ones that we're going to have to look at with clients that have legacy pensions. I'm sure many of you have one or two that will be impacted by this. So starting to talk to them about this issue, it is going to, again, provide us with an opportunity to unpack some of these more complex ones that we kind of only see once or twice a year, and you scratch your head and how do those rules work again, and so forth. So again, much simplified for us to move forward. And the other one here that I wanted to talk about today was the change in the residency rule requirements. So as I said before, we have 3 tests that sit within the current definition of an Australian superannuation fund. So we have that the fund must have been established in Australia. We then have our central management and control test, where that trusteeship ordinarily resides inside of Australia. And then we have our active member test. And most importantly, it's that active member ratio that we need to ensure allows for us to qualify and meet that Australian super fund definition. And so when someone goes overseas, ordinarily, we can't, or we don't want them to be active members, or we need to at least have active members represented back here in Australia, so that, again, we don't end up in the fund being non-compliant. Now, one of the most important parts of the central management control test, of course, is in the context of temporary absence, there is a safe harbour period that the legislation looks at as a 2-year period. So where that absence is temporary for 2 years, then that's kind of a safe harbour that the government has in place that they are otherwise satisfied. Now, what they are looking to do is to expand that temporary absence safe harbour from the current 2 years all the way through to 5 years for SMSFs. Now, the most interesting part here is the government is going to remove the active member test. So we're going to be back to 2 tests here to ensure that the superannuation fund SMSF meets that definition of an Australian superannuation fund. So what that is going to do is it's going to enable many more individuals to actually be able to make contributions into super, even though they may be overseas for some period of time, not on a permanent basis, but on a temporary basis. And again, this is expected to start from the 1st of July, 2022. So again, this has been a bugbear of the industry for some time, multiple submissions being made around simplification of these particular rules. So it's a great result for the ongoing advocacy that has happened within the sector, looking specifically at this issue. So what it's ultimately doing is it's creating a level of parity within SMSFs for members to be able to contribute where they're away. So quite clearly, within an APRA regulated fund, there would be a much larger representation of active members here in Australia, so there's no major issue. Our arrangements where we have under 5 at the moment, so 4 currently, or in particular it might be mum and dad, we end up in a problematic situation around that active member test that precludes them from being able to make contributions to ensure that we don't end up in that fund losing its complying status. The other thing to note is, again, this concept of this safe harbour around central management control is only relevant in the context of absence that is temporary. So the 2-year period is irrelevant when that decision to move overseas is a permanent decision rather than a temporary decision, okay? So it's just not an automatic, you get 2 years, or in the future you'll get 5 years, where that decision to move is a permanent decision rather than that absence is temporary in nature. So again, something that you need to be very conscious of and understand the very specific circumstances. And the tax ruling on that particular topic does look at all of those different factors around bank accounts, family home, cars, and other arrangements that have been put in play that will determine, again, whether that absence is temporary or permanent. The other thing then, just to note in respect to this absence stuff, not right now, but we will into the future, this introduction of all the director ID legislation. So where we are going to need to put enduring powers of attorney in play if someone does have that level of absence, and we need to put in place someone to step into the shoes of that individual, whether as a corporate trustee, there is going to need to be an obligation for them, that enduring power of attorney, if they don't already have one, to obtain that director ID in the future. And you can, if you forward plan this, there is up to 12 months prior to that step being occurred to be able to do that. So again, if you haven't sort of followed some of that director ID legislation, that now is starting to ramp up and is expected to impact the nearly 700,000 individuals that are involved in SMSFs. So again, there may need to be some further action given here around the deed requirements to ensure, again, that it meets the ongoing issues of a complying SMSF, both in the context of central management control, more likely to be related to the active member test requirements. And again, we've got different documentation around issues where enduring power of attorneys and so forth need to be instigated due to that absence of that member for some period of time on a temporary basis. So as we kind of get to the conclusion of today, so I might just have a quick look here if there's any other questions before I jump into the last little bit. So Rob's got here, what are your thoughts on the before and after September 2007 pensions, especially where there is a lifetime pension that started before September 07 and was converted into a TAP after 2007? So the question here will be, is it for age pension or is it potentially for RBL or transfer balance cap considerations? It would be arguably moving to that simplified approach would appear to be opportunistic to do so. I guess the question is if they've done that first step, if it's an age pension requirement, they've arguably moved from maybe 100% to a 50% asset test exempt environment. So how far the assets, how much further, if they remove that assets test in its entirety, would they then be impacted on the level of pension they get? Again, it opens up the flexibility. If you're looking at it in the other context, so from a transfer balance cap perspective, if they've gone from lifetime complying pension down to market linked pension, that next step, thinking through it off the top of my head, would seem like a positive next step. Any sort of pension that's that was a cap defined benefit income stream had a transfer balance cap result that was worse than the actual capital value. So unpacking it may actually provide an improved transfer balance cap position for that individual. But again, it's going to all be subject to the individual circumstances on a case-by-case basis. So I was more referring to the potential legislation saying that pension had to have commenced before September 07. Yeah, so September 07, it was pretty much the time when the account-based pension products came in. So that will cover off, prior to that, market links and all the defined benefit income streams. So from that point of view, it's simply saying from that point in time, we only have the ability to pay account-based pensions unless you are moving from another old complying pension into a different complying product. So what didn't we see in the budget? And as I say here, it's sometimes about what's not included that we need to give consideration to as we start to plan for the year ahead. So the interesting one here that I saw was there was no further announcements about the current temporary minimum pension relief that is in play. Now, that's not to say that there may not be something in the last month of the year, but historically, we would have seen something announced through this budget mechanism around either a continuation or a transition back, which we did see post GFC. We saw 50% move to 25% and then 25 move back. So it should be, at this point in time, you should be making your clients aware that the expectation is that we will be moving back to standard factors from the 1st of July 2021, unless the government is intending on making any other announcements in the course of the next 6 weeks, which would appear unlikely given that they had the opportunity in the federal budget to raise this particular issue. And given that markets have recovered, I know the level of income for some individuals may not have, but with markets really back and beyond pre-pandemic, there is really no requirement, I would see, in the government's view to have to look at extending that relief. And in particular, when you consider the retirement income review findings, that what they did say is that there is concerns that the drawdown rate in retirement phase is nowhere near ultimately what it should be. And therefore, the fact that people need to be really chewing into the capital base rather than seeing it as an estate planning tool is something that, again, this may lead them to. So there's a bit of an argument to say, from a government point of view, we don't want to give any further relief, because if they need to eat into the capital, well, that's really what the purpose of superannuation is in retirement phase, so that it is utilised over their retirement. And the other thing here is just around some of the red tape measures. And this isn't necessarily in respect to the budget. We did see it announced back in the 2019 budget. We saw the extension of this, but again, we've seen no further information at this point in time about the proposed start date on the 1st of July 2021. So our 2021-2022 financial year, about this choice of method for determining exempt current pension income, along with the changes for the disregarded small fund assets where the fund is entirely in pension phase. So again, we are sort of sitting and waiting. It's whether this choice needs to be made at the start of the year or the end of the year. Again, nothing about that around the federal budget. So at this stage, we continue to just wait and see. So before we finish off, what I wanted to ask you was, of those strategies that we've spoken about here, and you'll see it come up on your screen now, which of these budget measures do you believe is the most useful for your SMSF clients? So is it the first home saver super scheme? Is it the age reduction for downsizers? Is it the repealing of the work test, the 450 threshold for SG? Is it around the legacy pension conversions that can occur, or is it around the residency rules? So I'll leave this open for about another 30 seconds. So give it a minute. I can see plenty of people punching their answers in. So thank you for that. And I'll share the results with you. There does look to be one clear winner at this point in time. If there's any other questions whilst we're looking at this, I'll just have a quick squiz whilst we finish this off. I'll give it another 10 seconds. All right, I will close that off and share the results. So we can see here we do have about 64% the repealing of the work test, which is not unexpected. And interestingly, we then see our second one around the downsizer, and clearly we're going to see those two things dovetail into each other quite closely into the future. And the others are very much on the periphery in terms of the impacts with our clients. There will obviously be some with the impact by those, but there is a real key clearly in those contribution opportunities. So just as we wrap up, so the budget measures here provide a great number of contribution planning opportunities, and that was really highlighted in the polling there as well. So start to think about this, talking with your clients about the opportunities and the conversations that can be had. Of course, the devil is going to be in the detail around these and the timing of that, so it is going to need some forward planning there. We have seen some fixes finally to some long-standing issues in the SMSF sector. Again, they're going to have to contemplate how you deal with those, in particular with the legacy pension conversions. And most importantly, these budget measures, most of them are linked to a 1 July 2022 start date. We do need to remember that an election does stand between now and that particular date, which can, of course, have an impact on their outcome. Now that legislation could go through, so we could see bills get introduced, receive royal assent, and then it just has an effective start date of 1 July 2022. So therefore, a change in government, they would need to repeal that legislation. But we may also go through periods, and we did in the last election, where we were waiting on items to be finalised. And then with an election called, anything that was not yet resolved in either House of Parliament basically was now became defunct. So from that point of view, we're going to have to very closely watch the rollout of these measures and the implementation that the government's looking to do, because it is going to be subject to what happens between now and an election. And then, of course, what would happen thereafter based upon which government would then form office thereafter. So there is some fact sheets on specifically on superannuation. You can get the link off the slides, like I said, which I'll be sharing with everyone as a follow-up email after today's event. So thank you. Hopefully it's given you some great insight into what we've seen with the federal budget announcements. If you do have any other questions, please feel free to get those through to us. Other than that, have a great rest of the day, week. Good luck for those of you still lodging tax returns and so forth. All the very best, and I look forward to you catching up at one of our next events in the near future. Take care and bye for now. All right, so I'm just going to